Good afternoon. My name is Amy Bach, and I am one of the founders of the nonprofit United Policyholders. I am so pleased to be able to bring you today's program through our Roadmap to Preparedness program. How to shop when you've been dropped, buying home insurance in crisis conditions. Very pleased to be joined by a panel of experts. If you want to follow along with the slide deck on your own, you could go to our website at uphelp.org, follow this link, and then you can click on the right there where it's yellow highlighted, and you can bring up the slide deck on your own, and that way you'll have it for reference, for future reference. Just a reminder that United Policyholders is a 501c3 nonprofit with a 30-year track record of knowing about insurance matters, being a voice and an advocate for insurance buyers, policyholders, consumers, and particularly in the aftermath of disasters. And so we're not here to sell you anything. Today's program is free. It's designed to be educational. It's not designed to be professional advice, but to be information for you. Because we have now over 3 decades of experience in through our Roadmap to Recovery program in what kind of insurance obstacles people can encounter after a disaster. We have turned a lot of that hindsight wisdom and lessons that people have learned the hard way into preparedness guidance through our Roadmap to Preparedness program. So when we talk about recommending that you adjust the amount of coverage that you have on your house, it's not because we're trying to sell you anything, because we don't sell anything. It's because we have seen 2/3 of the people that lose their homes in wildfires come up short on their insurance, and we're trying to help solve that problem on the front end to avoid those problems on the back end. And a lot of the things that we'll be talking about today touch on the advocacy work that our organization does in the legislature and in the courts, trying to solve problems there. But what we're going to not really be talking about anything too political today, because really we know that if you tuned in today, chances are you've been struggling with keeping your home insured. And so what we wanted to do today is to give you the straight scoop from people who are in the trenches, selling insurance or regulating insurance, and giving you their best insights on how do you manage the situation, how do you navigate the situation, what are your choices in the here and now, and how do you flex whatever consumer muscle you have in a difficult situation here where your choices are very different from how they used to be. So I'm so pleased to have with me today Tony Signorelli, who's the Deputy Commissioner of the Consumer Services Bureau at the California Department of Insurance. Hi, Tony. Phil Irwin, who is an insurance agent based in El Dorado Hills, but he also has a special role as public relations representative for the California Fair Plan, CFP. So thank you, Phil, for being with us.
Thank you.
We also have Ruth Stroup, an insurance agent in Oakland, California, also here to share her expertise and guidance. And finally, last but not least, we have John Wheatley, who is an insurance agent in Santa Rosa with the Redwood Credit Union agency. John, is the name of the agency the Redwood Credit Union Insurance Agency, or does it have another name?
Yeah, it's RCU, Insurance Services.
Okay, gotcha. Thank you. All right, so just a quick intro here, nothing that you probably don't already know. We're here because home insurance in brush and rural wooey areas has become very hard to find and expensive. If you had never heard of the FAIR Plan before, chances are you've heard of it now. So we'll be here explaining what you can get through the FAIR Plan and all that. You also may already know, if you've been non-renewed, if you've been dropped, that some of the brand names that you're familiar with, and the Jake and all your friends from TV are not interested in selling to possibly, and you're having to put your eggs in a basket that you're not familiar with. So names of companies you've never heard of. So we'll be talking about that. We'll be talking about the difference in conditions policies that you can pair with a fair plan policy. We'll be talking a little bit about what is coming on the horizon in terms of rewards, discounts, and incentives to harden your home and create defensible space to make your home and your community more attractive to insurers going forward. So a couple more basic points. Even though your choices are limited, prices are high, it's still important to shop smart, which means you heard me say in the beginning, one of the reasons that my organization has gotten into this work of doing preparedness presentations all over the state and making friends with the experts that we have on this panel so we can give good guidance to you, is because so many people that we work with after disasters find that their dwelling was not insured for its true cost of putting it back. So we always want to remind you of that message because it's so important. The software that insurers use and give their salespeople to use often comes up with numbers that are not realistic for various reasons that we're not going to go into here. Just know that it's an ongoing challenge. Just a reminder that inventorying your assets is a great, easy thing to do to anytime. Just take your cell phone, walk around your house inside and out, talking, narrating, making a movie, make a little video, describing what you see, and then save that video because that will really be helpful to you if, God forbid, you do find yourself in a situation where you've had a loss and you need to prove up what you had. Okay, so just some terminology. You know, a lot of people talk about I was canceled by my insurance company, but in most cases today, it's not that you were canceled. A cancellation is typically in the middle of a policy. You know, usually your policy goes for a 1-year term. If your insurer finds, if you stop paying or they find out that something you told them wasn't true and they don't want to insure your home anymore, then they can cancel you. But they cannot, but what most people are dealing with now, what brought us here, is something different. It's a non-renewal. It means the policy came up for renewal, the term ended, and the insurer told you, we're not going to send you a new policy. We're not going to keep you as a customer. These other lingo you will get as we go through today. The DIC, the admitted or non-admitted, 2 kinds of insurers. An admitted insurer is fully regulated. Tony's agency has all the authority over them that they have over anyone, meaning that they have the authority over an admitted insurer's rates and forms and claim practices. Non-admitted, much lighter regulation. And we will talk about why that matters as we go through. The only other thing that really matters here on this right now is the lingo risk score, which is some of you may be hearing about this, that your home had a risk score that was unacceptable to the insurer. So where can you turn for help? These are the main sources of help. There are 2 kinds of insurance agents. There's one that's known as a broker or an independent. That would be John. That would be Phil. Then there's a captive agent. That would be Ruth. But Ruth, like many captive agents today, and that would be somebody who works for Farmers or State Farm. And normally they can only sell a farmer's policy. But today, the situation is a little different now. And people like Ruth, who are very proactive and on the case, have found a way to be able to find more options for their customers, which I think is, I know, probably very helpful for you, Ruth. Okay, so those are some of the sources. First question, if you've gotten non-renewed, if you've gotten this notice, did you get it 75 days before the end of the period of your policy? So they're supposed to give you 75 days notice. Tony, is your agency getting a lot of complaints from consumers that they didn't get the notice in time?
The law is fairly recent, but in the beginning, yes. But now virtually all insurers are giving the required 75-day notice.
Okay. And so if your insurer gave you that legally required notice and they're not discriminating against you, they're free to drop you. And by discriminating, we're talking about, well, I don't know. What are we talking about here, Tony? What would be an example of a discriminatory non-renewal?
Well, they have to treat you the same. All the customers of the insurance company have to be treated the same. In other words, you can't say, I'm not going to insure this type of house for this person, but I will insure the same type of house for someone else. So
Right.
if you have the same characteristics, the insurance company has to either insure both of you or not insure both of you. You have to be consistent in how they insure you.
Okay, but one thing came up when we were getting ready to go today. John was sharing that how hard it is when sometimes neighbors on opposite sides of the street, one will get a renewal and the one on the other side doesn't. John, how does that happen, and how's that not discriminatory?
Well, to Tony's point, I mean, everything is regulated, and somehow or another, the line for that insurance company was filed with the Department of Insurance, and this is where the appetite stops. So the department allowed for, and it just coincidentally happens to be down to a line, to a street line.
Right. Okay. So other than if they gave you the 75 days notice, then the only other question is there a moratorium in place in your area? Because as a result of a law that the legislature passed, and they gave the governor the authority to declare a disaster in a particular county, and then they gave the insurance commissioner, Lara, the head of Tony's agency, the authority to declare a moratorium in non-renewals as follows. So if you lost your home in the disaster or your home was damaged, then your insurer cannot drop you for they have to give you 2 renewals. And if you live in a home that's didn't get damaged or destroyed, and you are either in or near a zip code where a state of emergency has been declared, they have to renew you at least once. So those 2 rules are in place. Those are the moratoriums that are in place. And but if there is no non-renewal moratorium in effect in your area, and you got the 75 days notice, then it's perfectly legit to have a conversation with your insurer to try to get them to change their mind. But it's probably not worth a whole long conversation. Ruth, do you have anything you want to add on that? I mean, how much effort should somebody put into trying to argue back when they get their non-renewal notice?
Well, I always check to see if there's been a mistake, and I always ask people to check. I mean, as an agent, it's in my best interest to continue to insure somebody. That's how I make a living. So we find some of the carriers, more often the surplus lines carriers, just needed some vegetation cut back or something else. And so if there's something from a prior inspection, especially during COVID, a lot of the inspections were late. So carriers were trying to inspect properties and maybe get off of a risk, and then they passed their window. So it's coming up at renewal, but we regularly find inspection issues that show up at renewal that are completely fixable.
Mhm.
Also, in the surplus lines market, we have to file special paperwork that we shopped insurance with the department. Our carriers have to show that we shopped, and if for any reason our forms are late or aren't accepted by the Department of Insurance, the carrier is required to send that non-renewal notice. So we see a number of fixable situations. So I always ask about that first
Mhm.
because if it's fixable, you want to stay there. And then, you know, in this name of non-discrimination, we can't discriminate towards our client, you know, towards our client of 40 years, towards a multi-policy client. There's so many times I was like, why did this person end up getting non-renewed? You know, so they're like, why aren't you being like, people take it personally, and just like you
Yes.
said, don't take it personally.
We,
It's shocking and it's difficult. And as an agent, you know, we experience it too, because we've all had such a disruption to our own business. But we also have a lot of experience and a lot of empathy for what people are going through. So we're here to help.
yeah, and I appreciate that. I don't think people realize, you know, that this situation, it's really, I know it's really hard on agents and brokers. Phil, did you have anything to add on how much energy should one put into trying to argue back with the insurer that said they didn't want to renew you?
Well, I think they should definitely challenge it, you know, put in every effort they can. And even, you know, it was interesting because I think the timing of some non-renewals that went out in El Dorado County, as an example, it was one particular carrier. It wasn't as a result of the Caldor fire, but it was just before. And by the time that the moratorium got put in place, it actually fell to their advantage. So they didn't lose their home, but because that was put in place, these folks we were able to fight and keep their policies, at least for one more term, under that guideline. So again, I think it's worth to exhaust every avenue, every effort possible to keep them in a more favorable costing policy.
Yeah. So John, you know, you're up in Santa Rosa, and I know, I think some of the moratoriums expired up in your area this year. Is that right? What kind of an impact did that have? Did you have to really hustle?
Yes, we did. First, I'm absolutely in Ruth and Phil's camp on take the swing and try to get renewed and mitigate if necessary, if that's an option. But what it's not, and you are going to be non-renewed, you then need to be a good steward and work with an agent or a broker to get educated properly. There's just too much out there with trying to do this on your own.
Yep. Agreed. 100%. Tony, risk score. A lot of people have been hearing, oh, I didn't know. I know I have a credit score. I didn't know I had an insurance score. I didn't know I had a wildfire risk score, or even more so. Can a consumer find out their wildfire risk score?
Well, in many cases they can, but it's not required by law that an insurance company provide that risk score. It's required they provide you with a reason why they're non-renewing you, but that doesn't necessarily mean they have to give you the risk score. However, new regulations being proposed by Commissioner Lara, we just had a hearing last week. We hope to get them out by the summer, will require insurance companies to on one hand, include mitigation in their risk scores, which most risk score models currently don't do, but also advise consumers of their risk score when they take an adverse action like a non-renewal or a premium increase, that sort of thing, and allow that policyholder to appeal those risk scores in case there are mistakes being made.
Okay. I'm going to just throw this out to anybody on the panel that has an answer. Can a consumer find out what their risk score is in your experience? And is there anything that you tell clients they can do to improve their risk score, or do you just steer clear of that? Why don't I just start with you, Phil?
Well, you know, it's definitely a conversation that takes place. And I think today, and what's more common is just around ISO mapping, which is kind of a different topic altogether. But we do talk about the factors that are going to drive that point, whether it's distance of a fire hydrant or distance of a fire station, or is it a full-time fire station? And, you know, in some counties, there are options to petition to have a fire hydrant installed. And our processes for that, it's not easy. It's not an overnight process. And same with getting the ISO mapping updated as well is a process. So, but again, it's it's important to let everybody know what their options are, if, you know, or what's impacting the rate
Yeah.
that they have. So I guess in my world, that's probably something we talk about a little bit more.
You know, it seems like from the agents and brokers I've been talking to, that you probably know a fair amount about the rules of the different insurers that you are authorized, whose products you're authorized to sell. Is that true? I see Ruth, I see you nodding. Yes. So when, yeah, go ahead.
Amy, a lot of the things that make something difficult to insure have nothing to do with the homeowner. It can be like you're on a single egress or on a narrow street or a windy street, or there's a certain amount of slope. And that's just a location factor. We also I also talk to my clients a lot about where's the fuel compared to where their home is, just in terms of an evacuation plan, because so often we've seen fires where we have hot, dry wind from the east, when our normal Bay Area wind is cool, moist air from the west. So, you know, in Oakland Hills, when we had the fire, it was definitely that backward wind. The Napa-Sonoma Tubbs fire, definitely that backward wind. And so a lot of topography is just something that the homeowner can't change and can't fight.
Right.
And so you can do as much individual home hardening as you can, but there's a lot of things that if you choose to live there, that just comes with it.
Yeah, you know, not only does it sound, and I saw John also nodding. John, so you're pretty familiar with the, I'm trying not to use too much fancy terminology, but the underwriting rules that the different insurers have. And so, you know, but what people have been telling me throughout this crisis now for years is that the situation has been dynamic the whole time, meaning you could call State Farm 1 week and they would turn you down, and then you could call them 3 weeks later and you might get a quote. John, is that consistent with your experience?
Well, a little bit, in that it is interesting where carrier appetites, you know, company X and carrier Y won't, write in the zip code, they're non-renewing, but two other preferred companies somehow say, you know what, I'm okay with the risk in that area, I'll go ahead and write. But then a month later, because you think you can write in that area, you start knowing these things, and then all of a sudden the carriers that you were able to write with no longer are writing in that area. And again, they're regulated, so you can't just, they got approval to either write or not write in an area. They can't just stop. So it is kind of interesting to see the dynamics change relatively quickly.
Yeah, very interesting. I mean, these are business decisions that the insurers are making by and large, right? And since they are free to, as long as they give you the 75 days notice and there's no non-renewal moratorium in effect, insurance companies are still free to choose which customers they want and don't want, right? So, I mean, I think, Phil, when we get to the section where you're going to be talking about the FAIR plan and what's in that, in terms of like people being able to get out of the FAIR plan, let's say, you go to an agent and or you just shop and all you can get is a FAIR plan policy. Are you stuck there for the whole term, or can you, if you find a better option, if you keep shopping, as we always advise people to do, and find a better option, can you get out of it?
Absolutely. And that's definitely something we encourage everyone, as well as every broker I talk to as well. Even if you feel up front, you can't, depending, like if it's a home closing and maybe some of the non-admitted options, it's going to take 2 or 3 weeks before they can quote it. Even if you end up placing them with the FAIR plan initially, you don't stop fighting for your customers. If you know there's a better alternative that might just take a little bit longer and you need to place it for just initially with the FAIR plan, because technically that's what's available today, but something better is available, more advantageous becomes available for them, then definitely you can cancel your policy. There's no cancellation fee or short rate fee. So that's the goal. The goal is to not be in the FAIR plan, to get out of it.
Right. All right. Well, we're going to get there in a minute. I just want to go through a couple of more background things. Just so everybody out there knows, if you haven't taken our survey, the California Home Insurance Survey, please take it. It'll only take you a couple minutes. We've already got well over 1,000 responses. We are since we launched it in January, we are taking the pulse out there in the market. We will publish the results of which companies dropped people and where they were able to get replacement coverage. This is something we're doing in collaboratively with the Department of Insurance, and they are ongoing doing the same kind of data gathering. So ours is just a little bit more grassroots. Also, for those of you who are in a WUI community or a community that has a fire safe council, you know, getting involved in the effort to get as many people in your community to participate is a really time well spent these days, because just like we're doing this right now, giving you this free educational information, we're also doing a lot of advocacy work. And I think that it's going to, in order to get insurers to be a little bit more confident again in insuring homes in California, I think they want to see a lot more participation in brush clearing and home hardening and defensible space, in not just individually, but in throughout the communities. And that's just a little bit more information about this work. But the point is that when we know, and why United Policyholders is working, we have this WRAP initiative where we are working to get standards in place with Tony's agency for the kind of rewards and incentives insurers should be giving you when you have been proactive about reducing your risk. We know it's part of the reason we're doing it is to try to help restore affordable, available home insurance options, because when insurers incentivize and reward risk reduction, we all win. You know, that we're making it less likely that homes are going to burn. And we're also addressing some of the reasons why insurers have been really, non-renewing and having less appetite for risk in parts of California. So the Department of Insurance, this is their website. They have a toll-free number that you can call to get help. They have some very useful tools. They have the homeowners comparison tool. They've got an insurance finder tool. They have a chart where you can see which insurers are offering discounts now for changing out your roof, or putting in dual pane windows, or various things like that. Anything you want to add on this slide, Tony?
No, I mean, the chart is a really good source. It's relatively new on our website, and we keep adding more insurance companies to it as they come to us with either new discounts for mitigation, as well as even community-wide discounts for if you're in let's say a fire-wise community, for example, or a shelter-in-place community, you may also get a discount.
Yeah, and again, I'm trying to stay on what is, as opposed to how we would like things to be. And we know there's a lot of frustration out there from people who have done these things, have replaced the roof and created defensible space, moved a beloved bush away from their house, and their insurer doesn't seem to be rewarding them. And so we are working very hard to change that, because we know not only is it frustrating, but it's part of the problem that we have to solve. So those are the ways that Tony's agency is working. And then the ways that agents and brokers are helping. You've got some excellent professionals here that are not, they not only were they willing, they were not afraid to show up on a program hosted by a consumer group, because legit, they are consumer advocates as well. And so folks like Ruth and Phil and John have been working probably harder than they ever have in their careers, I'm guessing. Is that a fair statement there, John and Phil and Ruth? Would you say the last few years have been the most challenging of your careers in terms of helping place people?
I'll say absolutely. I'd say since the campfire began, it's been nonstop, everyday conversations from beginning to end about finding insurance alternatives in the WUI.
Yep,
agreed.
Yeah.
Same.
And you don't expect carriers, like we said, carriers leave the state, which means that not only are we shopping for people who are having traditional non-renewals, we're shopping for people we weren't even expecting to have to spend time with.
Yeah.
It's not so different from my friends in Florida who've had to shop after hurricanes and things like that. And I didn't believe how much effort they put in. And it's now I believe it.
Yep. Yep. So now we're going to do a little bit of naming names. So this is just on the topic of, you might have to go with a company you've never heard of, or you might be able to go with a company you have heard of. Now, we talked about these two different kinds of insurance companies, admitted and non-admitted. And like, it seems like, I don't know if it's worse in insurance than it is in other fields, but there's often in insurance, there seems like there's 5 different words to describe the same thing. So admitted, very straightforward, right? An admitted company is licensed, they're fully regulated. CIGA stands for the California Insurance Guarantee Association. They pay into that. That means if they run out of money, there's still money to pay those claims. But when it comes, and these are some of the ones that the admitted companies that people are still having some success. So I want to ask our producer panelists, is there any name on this list that shouldn't be on here? Is there any name on this list that you know is completely shut down and not an option for anyone? Okay, that's good. Are there any admitted companies that are on here that you're having some luck with that are not on here that you've had some luck with, the names you want to name?
Yeah, a couple. We see Amica offer some appetite, just in the middle range. We see USAA have a little bit of appetite in some range. You have to be a policy member there. And like one of our other panelists said earlier, the appetite changes all the time. So we're having experience, for example, with Travelers where they had much bigger appetite and now they have a little less appetite and people are surprised. So then they think the whole market's closed down. And I would say that like Farmers, Foremost, Pacific Specialty have almost the same exact appetite. They're more fire line appetite than a zip code in this area, at least. We still, and if you end up needing to go with the fair plan, all these carriers, if you have a relationship with them, can offer you a difference in condition policy combined with the fair plan, assuming that the agent wants to write the fair plan. Not every agent writes fair plan.
Yep.
I would add one more too, is we've had Hippo's just kind of had their own, their appetite's been a little bit different than the norm. So there are cases.
Okay. What about Lemonade? We've heard that somebody just in our survey, we peeked in to look at the survey results before we started. We got some people that said they went with Lemonade, but is that, I don't know who their actual
company is.
Yeah, are you, Tony, is Hippo
Lemonade.
Lemonade, are they an MGA now, or what, are they just a
Lemonade is one of the few kind of tech companies that's actually an insurance company.
They are.
So
okay.
Lemonade is an actual admitted licensed insurance company, although they use like an application to sign you up and handle claims, that sort of thing.
Okay. And Hippo as well, or are they some sort of?
It's Spinnaker is, I think they write it through Spinnaker, which they acquired.
Okay. All righty. Now we get to the word, well, there's many words to describe the same thing. Non-admitted, surplus line, specialty. Now, Ruth, do you want to give us your thumbnail for what this means?
Yeah, it's a secondary market, so you have to be declined in the admitted market, and it's a market that's designed to create coverage for people in a higher risk situation. Excuse me. And to me, the biggest difference is that I'm so sorry.
That's right. You want to hear? We'll come back to you.
Yeah, no, the biggest difference is that you don't have the state as the backstop regulator. for things like complaints or for price controls.
So, John, Phil, anything you want to add to, I mean, well, let me just throw something out and then have you riff on it. So, you know, we, as a consumer advocate, I've always told people, you know, the big problem with a non-admitted or surplus lines insurer is that they're not covered by this insolvency fund, SIGA. And so if they were to run out of money, you'd be out of luck. But lately, professionals have been saying to me, actually, that's not as big a concern. I think the bigger concern is the actual contract and what it says and what it excludes and what it covers. What do you think about that, John and Phil?
Policy language on the secondary market is critical, and they're all different. And it's critical, you know, that you review it to make sure you understand, you know, from the replacement cost to the extended, you know, all of those things. We try very, very hard, you know, before we put someone in the secondary market, even if we can't write in our preferred market, we'll actually tell our members to look at some of the captives, to look at the farmers or the state farm, to first make sure they've exhausted the primary market before going to the secondary market. So that's really important to make sure that because there could be an appetite with a carrier still. But then it is really important when you have to go to the secondary market that you know what you are getting. And then if you end up in the FAIR plan, that you get the right DIC, difference in condition policy, to fill in the gap.
Phil,
You know,
anything you want to add there?
Yeah, I would absolutely agree. And you know, the other thing that you're seeing at this point, and it's because it's already a very pricey circumstance for these consumers, and you know, and what we're seeing is it'll appear to be a reasonable quote, and then arbitrarily, almost, it feels like an IRPM comes on that quadruples what they originally quoted, and it just seems
I'm sorry,
like
what is IRPM?
individual rate premium modification. Is that basically they can, based on a fire line or whatever they're designating to be an additional risk, it's like a surcharge that, and it's a percent, and they do it based on a percentage, but they'll increase the premium. And it just, that's kind of where I've seen with a few of these folks on here. And we still look at it, we still talk about it with our customers, and ultimately give them, explain the circumstances, and the same thing, look at the way out the contract language. But again, that's just something I'm seeing more and more, where it looked favorable. And then all of a sudden it's 4 times what they originally quoted.
Because they can tack on their rates are not regulated, right? So they're a lot more free. Tony, my understanding is that surplus lines, not admitted companies, they weren't really built to insure homes. They were for like weird specialty risks, right? Like a you know, drilling operation or something like that, right? How did this come to pass that there are all this type of sort of funky, less regulated type of insurance company selling home insurance?
Well, it was really a long process. I mean, you're right. Originally, they would insure like pesticide companies and, you know, other high risk commercial entities. And then also in the high end homeowners market, some of them entered that, where, you know, you have a $20 million home that the traditional market might not want to insure. A Lloyd's or another non-admitted company might insure those high value homes. And some of those companies have slowly moved down in terms of what they would insure to lower valued homes as the market increased for them and the market tightened in the admitted market, and there was more opportunity in the non-admitted market. They would they'd be able to write at lower values, and that slowly led to more non-admitted insurers writing traditional homeowners policies, even though, as was just mentioned, look at the policy, because they're not regulated and there's going to be differences in coverages and exclusions, like you said.
Right. Have any of you actually seen a policy come across your desk that has a wildfire deductible? Yes, Ruth says yes, because I've been fearing this day and I've heard about it.
Yeah, we saw a carrier with a 30% wildfire deductible, and so, that's a carrier essentially telling somebody that they don't want them. So we were actually, all the people we had in the policy with that sort of poison pill, we were able to replace with a different surplus lines carrier. So we didn't end up having to go to the fair plan, and we got better coverage for about the same money. So, if you're in the surplus lines markets, you may still need to shop. You may only be able to shop in the surplus lines market, but it's worth asking your agent what the trends they're seeing in rates, because most of us who shop this market shop multiple carriers. And, if I know that I have a carrier recently had a 20% rate increase, and they're still in general a better price than some of my other carriers, and I ran 2 or 3 comparison quotes, and now I can with confidence tell the person, yes, it's a higher rate, but you're also still in a very competitive rate, and that's important.
Okay, so now we're going to get to the FAIR plan. And we have a publication about the FAIR plan's policies and how it works if you are insured there. And the guy who helped us write it is right here, Phil Irwin. We wanted to make sure that it would pass muster. So Phil, you're going to take over and go through some of your slides here explaining what the FAIR plan is all about.
Great. And some of this might be obvious to you, but again, if you don't know the basic about the FAIR plan, we're just going to kind of start from the beginning. So the FAIR plan writes basic property insurance, including fire coverage for homeowners who cannot obtain it from a traditional insurance carrier. The FAIR plan is often a temporary safety net for homeowners, established to ensure all homeowners have access to fire insurance when other insurance companies won't provide that. The FAIR plan is a private association comprised of all insurers licensed to write property insurance in California, and the FAIR plan is overseen by a governing board that includes the California Insurance Commissioner and insurance company executives. Go to the next one. So how the FAIR plan works. The FAIR plan will insure any home in California if it is an insurable condition. It has not been vacant for more than a year, and there is no illegal activities that take place on the property. And that's basically it. The FAIR plan will cover a property regardless of its wildfire exposure, and the FAIR plan is required by law to issue policies with actuarially sound rates sufficient enough to cover risk exposure and anticipated losses. I'm off to, okay. Wildfires in California are obviously more frequent and more devastating, increasing the risk of insuring wildfire exposed homes. The growth in risk has led to more private insurers issuing non-renewals to their customers, which is what we've been talking about. The insurance crisis has led to an increase in the number of concentration of FAIR plan policies in fire-prone areas. The FAIR plan has already experienced significant policy growth over the last 5 years and is only expected to expand further. Without an effective solution that supports homeowners and traditional insurance markets. Next slide. Okay. Following the passage of Senate Bill 11 last year, the FAIR plan began offering a farm policy product for farmers and vintners, filling a critical gap in the insurance marketplace. The FAIR plan is increasing commercial coverage effective May 1st to 8.4 million for commercial property.
And Phil, you can insure a home up to 3 million through the FAIR plan, correct?
Total insurance value of the policy is 3 million. So,
Okay.
So across the coverages on a homeowner's policy, correct? All right. So getting covered by the FAIR plan. So it's important to shop around for a policy through traditional insurance carrier before purchasing policy through the California FAIR plan. Check the Department of Insurance website, which we showed the link just a few minutes ago. Contact your existing insurance agent and broker. It's really important that, as the insurer of last resort, does not mean it's the insurer of last resort for your particular agent or broker. So many times there may be carriers or options beyond what your particular broker has access to or is aware of. So again, it's definitely something you want to do is encourage them to look beyond. And if you know there's an option, even a potential option, definitely encourage them to go down that path before they come back and place a fair plan policy with you. So the fair plan, and this is a great slide, but the fair plan can be part of comprehensive coverage. So with many more DIC options available on the market today, the fair plan can be part of a comprehensive package. Same as flood and earthquake policies, in addition to the endorsements that you can choose with your DIC coverage, your DIC carrier to meet the individual needs. So really just depending on what the individual needs are, you can choose which DIC option fits them the best, or which endorsements would complement that the best for their needs. So that's
okay. And then thank you. And these are just some of the options that you can add when you purchase a fair plan policy. And I know, Phil, and you had given me a couple slides that were aimed at brokers, but because our audience is consumers, I took them out. But I think, I'm going to ask John and Ruth, in normal times, you know, I'm guessing you didn't place a lot of risks of the fair plan, right? This is sort of a new era. So John, did it take you a while to get comfortable putting a client with the fair plan?
Yes, I've since, what was it, the 2017 fires.
Mm-hmm.
Since then, we have become, pretty proficient and extremely good at placing business in the fair plan. And again, to everyone's point, it's the last option we try to do.
Mm-hmm.
But because we know it well, and we know these difference of condition policies that each carrier has and the options, it's a solution that will protect you. It's again not the first one we want to provide you, but in the event that is the last course, you are getting protected and having a pretty full secure policy with two policies to make it work.
Mm-hmm.
And you should feel good about that. But yeah, we've increased significantly.
Yeah. And I know that just getting agents up to speed on the options has been a challenge, because a lot of agents just didn't even want to go there. So Ruth, you want to give us the lowdown on pairing a DIC, a difference in conditions policy, to fill gaps in a fair plan policy, and what kind of options you're helping your clients with there?
Sure. So we look at the coverage, we're able to offer on the difference in condition or the companion policy more of a boilerplate policy that the carrier offers, and we do more customization on the fair plan. We do have a policy at Farmers I like very much that allows me to take reduced coverages where I don't need them, so I can really think about how things are covered. Typically, the biggest coverage on the companion policy is water damage, and as much as we worry and fuss about fire, the number one claim in our industry is water damage. So these policies are extremely important. You don't want to go without them.
Because the fair plan policy does not cover water damage,
does not cover water damage.
Okay.
So, and then the liability coverages. The companion policy also covers theft, but it's not like the kinds of things we see stolen are small and a little bit more mundane. Somebody will come in and steal your golf clubs or computer or a bicycle, and those aren't great claims, especially in this tight and hard insurance market. So we really talk to clients about what makes sense. What we do think is important that neither the difference in condition nor the fair plan does is if anybody has significant jewelry, it's especially important to have a jewelry floater, because many of the difference in condition policies have very limited coverage for things like jewelry.
Mm-hmm.
And they don't, and like ours at Farmers does not allow us to add a floater. So we have some jewelry insurance companies specifically we work with to make sure that clients have that covered. Okay.
All right, so I'm going to start with, I guess I'm going to hit you, Phil. How can a consumer tell if an agent is up to speed on current or new options?
Well, I've got to say something that's been really impressive is the consumer has become much more well-informed as to what these policies are, what the individual components are. And so again, I think it's first important to educate yourself through a resource such as United Policyholders, and really just ask challenging questions. You want to make sure that everything is every line item is considered. And even in just as an example, the difference between fair rental value, which is the terminology that the FAIR plan uses for additional living expenses, which is a very important component. But because it's called something different on your DIC policy, you want to make sure that it's still equal, the amount is equal to what's on your DIC policy. So again, just be educated, go through each line item. And that's really important. You want to challenge them about your coverage A amount. How did you come up with the coverage A amount? Did you use a tool? What, really, what your thoughts are on that, and just really challenge them through each talking point on their policy. It's important. Again, I just can't encourage them enough, and to hear some different schools of thought. Go talk to multiple people, which again isn't something common to as a broker that you'd say, but you definitely want to encourage them to. And when they get the renewal package from the FAIR plan, the first thing it says is it's time to shop. Make sure you're going out shopping.
John, is it ever safe to insure through a non-admitted or surplus lines company or a brand you've never heard of?
Is it ever safe? Well, and sadly, in some cases, you might not have an option.
Right.
And so knowing that us as professionals aren't going to put you in a non-admitted company. We're going to first try to get you in a preferred company. That's the good thing. And all of us that work with non-admitted carriers or the surplus lines, you learn which ones you want. You learn which ones have the right policies to take care of, in the time of need or a claim, that are going to pay the claims, that aren't going to be the headaches. Well, I mean, they're all a headache, but they're gonna go through the claim process with integrity. So I don't know if safe's the right word. I think it's you should feel comfortable and trust your agent or broker that if they put you in a surplus company, they've done the due diligence of which one of those that you should be placed with. Might be more another way to look at it.
Better way to put it. Okay.
Yeah.
Ruth, how can a consumer tell if an agent or broker is looking out for their best interest, or just wanting to earn a commission and keep them from going somewhere else?
I think that one of the first things is to ask questions, right? People sometimes think insurance is say 15% kind of business, but really it's a relationship business. So when you're shopping for insurance, that's about the best day you have for communicating with your agent. Understand if that communication's a little rough, that may not be the person you want to talk to on the day you're actually using your insurance, and it's one of the worst days in your life. And it's fair to ask the question. It's fair to ask the agent, hey, what's your experience in this market? Are there any trends you're seeing? If I go with you, will you be able to explain the coverage to me? And, I meet some very good new agents from time to time, and they're getting great support from their management, and there's no reason not to work with them, because ultimately insurance paperwork, it's on the paper of the insurance company. It's not necessarily the agent. And I've had some, so ultimately it's like, are they responsive? Do they answer your questions? Can you understand the way they explain it, or is it all jargon? So, it's common sense for any of your financial services matters. Like, just understand that the day you shop for the policy is the best day you'll ever have in terms of communication with that agent. And if you like them, then sure, consider it.
Yeah.
The other thing we didn't talk about, though, was also the insurance companies all have financial ratings through AM Best. So I think that the agent should be able to share that with you on any company that they're. Oh, there you are. This is live.
There we go. Right. Yeah. So Tony, what is the Leslie list? And is that something a consumer should use if they want to go? Is that the same as calling AM Best or trying to look something up on AM Best?
Well, AM Best is going to talk about the financial strength of the company. The Leslie list companies, while they have to meet certain minimum financial qualifications, they have to meet other qualifications also. And so if they're on that list, there are no dings against them, so to speak.
Okay.
that the commissioner has found and the Surplus Line Association has found that that means that they're bad for consumers.
Okay.
It doesn't mean all of them are going to be great. It just means that they've met the minimum qualifications and that we're not seeing anything that you should be worried about based on them being on the list.
Okay. So let's talk about bundling. I know for, in this scenario, and in every scenario, if I was helping my daughter shop for auto insurance, she's a young driver, and I was able to, I said, I think you should probably try to get renter's insurance and bundle it with a auto policy. Maybe we could get you a better deal on your auto insurance. But with homeowners, I always question whether it's worth it. So I don't know. Let's see. We'll start with Phil. When or how can bundling benefit a homeowner? And in this situation, does it help you?
Absolutely. So the opportunity in this case is with the DIC policy. So basically you would bundle that with the auto insurance or any other policies they might have, including umbrellas or boats, RVs, those types of things. So it definitely helps. Unfortunately, it's on the smaller portion of the overall homeowners premium because the FAIR plan is not eligible for those types of discounts. But again, it's still better than not getting those discounts.
Okay. So Ruth, how can a consumer tell if the FAIR plan really is the best option versus a surplus lines, for example? Is it just a cost comparison? How do you generally guide folks?
It's, the FAIR plan doesn't really want customers that can qualify for surplus lines policies. So to understand if the FAIR plan is the best option, I think you have to do a bit of shopping with somebody who has access to surplus lines markets. So one of the things about my agency is I made a decision a long time ago to be able to take advantage of farmers contract where we can write in the surplus lines market. Not every agent does that. And there are, I think one of the ways that things people need to understand is little things about like where they live. So are they on a single egress or dead end street? Are they in really high fire conditions? And then also, what do their neighbors say? If the neighbors that are going through the same thing are like, yeah, we're in FAIR plan too, you kind of want a FAIR plan area. But I think this is a case where, the more involved you are in your community, the better you can understand what's going on in terms of your insurance options, because everybody's having a slightly different experience based on the carrier that they're currently with.
Mm-hmm. Okay, very good. Thank you. So John, this is a tough one. How can a consumer tell if an agent is recommending the FAIR plan just so they can keep their business and sell them a DIC versus, do the legwork to find something outside the FAIR plan?
Yeah, well, in my opinion, I would say that if you weren't presented with options, I here are the 13 companies I represent, all 13 of them said, no, they won't write in this area. So I'm going to take you to the secondary market and I'm going to try to find these places. If there is an education and discussion on the process of how you derived at the FAIR plan, then you probably need to continue shopping. But hopefully the agent has educated the consumer along the way on, hey, I'm going to first try to do this. Hey, I got struck down. And I think you heard me say earlier that before we go to the FAIR plan, we'll have our members circle back and try some of the captives just to be on the safe side.
Yep.
We're kind of like the Macy Santa in that if we don't have it and Kimball's does, it's better to go to Kimball's than the FAIR plan. It's better to get that preferred policy.
Mm-hmm.
But there ought to be education and the consumer should be on that journey with the agent or broker on that. Versus, okay, I've got you a policy and I have this DIC that will put it all together for you. That can't be the first solution.
Yep. So these are sort of goes without saying, but I think everybody probably has now gotten this. We're getting to the end of the program, that the qualifications you want to look for are integrity, access to markets, and active in the market, proactive. Somebody who, you know, and like we said, a lot of people that do what Ruth and John and Phil do have been pretty discouraged in recent years. It's tough. But you know, we have all these three experts on today because they are all placing people successfully. So it can be done. And they all have integrity. So just a few reminders, no matter which insurer you end up with, your dwelling coverage A limit should be enough to replace your home with one of similar size and features. We give an example. Most people can know how much square feet of space you've got in your house. That's and then if you look at your current insurance policy and you see how much your dwelling is insured for, and you divide it by the number of square feet, that'll tell you how much money the policy would give you to pay a builder. Generally speaking, there's lots of nuances with if you have riders and things, but the basic coverage on the main page, the declarations page of your policy will get you want to have that general idea, because in most places where wildfires occur, you're going to want to have at least 250 or more with a little bit of a cushion, because 120 square foot or 180 is not going to get, you're not going to be able to get a builder to put your house back for that kind of money. So these are just a few reminders about what matters. And, you know, again, I mean, we are practical at United Policyholders. So we know that now is not the best time to be nitpicking when you're shopping. At the same time, you know, you're trying to insure what for most people is your biggest asset. So you do not want to skimp on these things, getting replacement value coverage, getting an extended coverage buffer in case you need it, having adequate coverage for if you have to make upgrades to your house for building codes, and then knowing what's excluded and limited, just basic stuff, right? And these are just the common items that a lot of insurance policies have a cap in, and if you want more than the basic, you've got to add to it. So just a few more questions before we wrap up. For a household on a budget, I'm going to start, throw this one at you, Phil. Is it better to adjust your coverage A limit upward or buy an extended replacement coverage rider?
Well, so the extended dwelling coverage for the FAIR plan dollar for dollar is the same amount. So if you just add 25% more coverage,
Okay.
But again, there are some options where you with the FAIR plan to put more weight on the coverage A, because you could use up to 10% of coverage A in other aspects of your policy too. So I mean, again, that's sometimes we do encourage more in the coverage A. Either way, but have that dialogue with the customers, what's important to them, make sure they understand how it works, and let them decide what fits them best.
Okay. So I'm going to skip this middle question because we're running short here, but Ruth and John, I'd love to hear from both of you. Which of the optional riders do you generally find most cost effective in terms of getting the most coverage for the least money? And by that, I'm talking about an extended replacement rider, a code upgrade, bump, that sort of thing.
I'll go. The things like building code, some like the FAIR plan goes up to 10% and no further. And you really need the higher, like when I look at the FAIR plan versus the difference in condition, I don't need so much building code coverage for the difference in condition because I'm not dealing with the same kind of claim. I get as much, I try to go for extra difference in extra code when I have an older home. I try to go for extra code when the client expresses a desire to rebuild. Right. Many people will not rebuild, and that's an important thing to consider. We like the things that make the policy a little more user friendly. Some of the things like equipment breakdown. If you can we started to see these sort of lightning and power surges from PG&E. If the power goes out, the insurance company's not going to cover that. But if the power surges back into the line, there's coverage with some carriers for that. We had a client with a $30,000 loss from power surging back into the line after it had been turned off for some time. We like coverages that deal with erosion and water damage because a lot of these properties are on hills and they have more potential for water damage than they might consider. And we like riders for things that cover things like sewer laterals. If these properties built on the slope, especially when a lot of the clients that we're dealing with are seniors, they've been in their house a long time. So some of the coverage that we design for people are designed for people who may not be on this regular cycle of maintenance. In my agency for years, we mostly dealt with people who were in the process of buying a home. And the home is in a very different condition than when somebody's been there 30 or 40 years.
Yeah.
And now they're having to replace their insurance. So, we definitely want to understand how the person will use the home. Ultimately, the most important thing is if there was large damage to this house, what coverage would they want to have, based on what they want to do next, what's their next home. And then if there's medium damage to the house, how do they want the insurance company to show up? And a lot of times it's just budget constraints as to how much people can buy because these policies are so much more expensive than what they've had in the past.
Yep. John, anything to add?
I think that was very well said. And we are similar in our approach to how we create a policy package for our members. We're also pretty big on the backup sewer and drains, depending on the age of the house. That's one that we pretty much make sure is a default too, where we see that be issues from time to time.
Yep. You get a fair amount of coverage for not a whole lot of money. So because we're making this deck available, we're not going to go through all those. We talked about seeking out a proactive agent or broker. These are tips to save money to the extent that you can. Raising your deductible. Most consumer advocates I know carry $5,000 deductibles because we know that even a small claim can put you in a higher risk category, and it's really a good idea to use your insurance for the really big stuff. So get quotes with different levels of deductibles. It's easy to say, like you can reduce your coverage for contents and maybe other structures, because I'll say, well, stuff is stuff, but I think not all insurers will let you do that. Is that right, Ruth? Like, will let you reduce the coverage in the policy for contents and other structures in order to bring the premium down? In this high risk market that we're talking about, where we're getting away from the package policies, that level of customization is a really important way to control the cost of your policy. Okay. All right. Unusual options only to be considered due to current circumstances. ACV only, meaning a policy that would only pay depreciated value. That would only really make sense for if you're a senior and your home's paid off. A home that has had high appreciation and for sure you're not going to want to rebuild. Reduced loss of use coverage, reduced personal property coverage. I don't think we're going to have time to talk about reverse mortgages. Just to wrap up then, are there any other tips that any of you have for consumer shopping in this challenging marketplace? And I have to say, you've all been great. But if there's anything that you think that we didn't cover that you want to add, now's your time, Phil.
Yeah, I'm going to go ahead. Something that's very important is, finding a broker that's going to use the same vigor to find at your renewal time to really research the options again, versus just show you that attention up front for the first term. It's really important that the same exact effort at a minimum goes into your renewal process as well. So you really want to make sure someone that's going to try to remarket your coverage options or what's available for you at your renewal the same way they did when they earned your business the first time around.
Yes, thank you.
Yeah,
John?
I literally was going to say the exact same thing, that today you cannot. This is not a checklist where you're satisfying your loan by having, proof of insurance. This is your second biggest asset, and you can't afford to not review it year over year. And you need an agent or a broker to help you with that for sure.
Yep.
Well said, Phil.
Thank you. Ruth, any closing thoughts? Any beyond what we've said?
What I encourage people to do is to treat this shopping as part of a larger preparedness plan, and to really think about how, now that the insurance company has identified you as being in an area of high fire risk, understand that your family, it's people first always is one of the things we say in the agency. So really plan to take care of your people and your pet people and all the beings in your world, and understand that insurance is there to replace property and to protect you financially. So, put your priorities in order, do a little more planning, and know that just because there's been changes in insurance doesn't mean that that it's the end of the world. You can always get coverage.
Well, that is a really important message here. I think that, for all its flaws, or the flaws of the gaps in what the FAIR Plan covers, we're very lucky to have it in California. It's actually a good recipe. And I know, Tony, there's good efforts being made to make the FAIR Plan options more similar to a regular home insurance policy. But, for now, there are solutions in this market. There are strategies. And you've heard today from 3 professionals that feel fairly confident that they are still being able to help their clients navigate. And I know how hard your team is working, Tony, as well, to try to tackle the underlying reasons why the challenges are so formidable. So I just want to really thank all of you again for your excellent guidance, for contributing to the program. We will be making this program available online for people to watch. It's been just an absolute pleasure to have all of you with us. And I wish you all a pleasant evening. Stay safe and healthier. And thank you again so much for your time and expertise. And that will conclude the program.
Thank you.
Thank you.